Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
All right, we're live. We'll kick off with some good news. Let's see what we've got. Have you guys got any good news this week before I dig into my treasure chest?
Is it AI or nuclear or genetic or air purification related?
I don't have good news. I'm asking you for some good news.
No. Okay. No, I don't actually.
What about you, Claude?
Come on, Claude.
You put me on the spot. Gen Z is overtaking the baby boomers, and
Okay,
hypothetically, if we have a
demographic battle,
a vote or whatever, at this point, millennials plus Gen Z should be able to unite to overcome Gen X and the baby boomers, especially, of course, considering how many of Gen X and the baby boomers are on our team. So
I don't know if I'd be on Team Gen Z. I'd probably rather partner with Gen X. Represent, Andrew. I don't trust Gen Z. Youngins.
Gen X, clearly the best generation for starters.
Property prices, we need to partner with them. Like, and they Andrew's got their back. See, Andrew's on the Gen Z team.
I am 100%. You know who else is? I'll give a shout out to Alan Kohler. He's great quarterly essay.
He is.
Was that good? He's a boomer.
What a legend.
Very much on.
We literally talked about that last week, I think.
Yeah, we did.
Maybe we cut it for time. I can't remember.
There's always more time to talk property, Matt. When will you learn this? We can stretch this out for a 4-hour marathon podcast.
All right, let's see some other good news. So the lithium route deepens. Battery metal is now down 75% this year.
Good times.
I think it's a good
sign. Can I just say, not to claim any great prescience there, but I mean, we all called that. Like, that was the most obvious call that you can make. How many commodity sort of cycles do we need to go through before we recognize that this is, as night follows day, these kinds of things always happen?
And it gets me thinking, right? Like, you have this situation where it's so bizarre, which we saw like last year mostly. I guess it's sort of come down now. But you have this situation where people who feel antagonistic towards environmentalists for whatever reason, and they invariably own coal stocks, and they're like, the coal price is going up, they're making heaps of money, and they're like rubbing it in the face of environmentalists, being like, yeah, suck it. Like, no, dude, this is what the environmentalists wanted, dude. They actually wanted coal prices to go up, and they want lithium prices to come down. If people get confused about whether making money off, super profits off something is actually, nobody who wants to see us use nuclear or renewable energy over coal. Nobody wants a low coal price. If you want that transition, you want a high coal price. And the same goes for lithium. So that's why, for anyone thinking they might own lithium stocks, oh, why are these guys celebrating that my lithium stock's down? It's not that. If lithium goes down in price, becomes cheaper, then you're more likely to have more electrification and ultimately less coal power.
Yeah, and just the inevitability of that price fall. I think the simplistic thinking of the world will see a very big and sustained increase in demand for rare earths, including lithium. It's like, yeah, no argument there. It's just that it's super abundant, and there will be a supply side response. And that supply side response will push the price down. So the demand hasn't gone away, right? And as you rightly point out, Claude, in fact, I would suspect it's good for demand, right? Like, it's cheaper. It's got a lot of benefits for that. But I just make the point for the next time we go through this little cycle that someone says, oh, the world is going to need more X, therefore I'm going to buy that. Just make sure that X isn't a commodified product, because if it is, there will be a supply side response. And you are playing a game of chicken. You may do well if you swerve in time, or you may not.
Yeah, I mean, and there's always some report of why there's not going to be any supply response, right?
Right.
And then you just hear everyone's saying, it's like, every mine is like, there's no supply response. That's why we're opening our new mine. And it's like, just add all those up.
Okay. Yeah.
The other thing is, there was a lot of carry on about there being a copper shortage for a while now. Even I thought there was something to it a while ago, and that thing's just stayed flat, ever since there's supposedly been a copper shortage, it's actually up a bit recently. But also, hey, so if copper's up, isn't that an anti-recession indicator? Isn't that a good sign for the global economy?
That was what it was called, right? So basically,
well, right?
copper is one of those commodities that has a lot of huge amount of industrial uses in all kinds of things. So if there is a lot of demand for that, it means that there's a lot of activity in the economy. So you're right. Yeah. And hence Dr. Copper.
It's been flat to up. So, perhaps
the economy's like, look at the US GDP is booming, right? Like, the economy is the global economy is still doing very well. There's definitely parts that aren't, but in terms of actual GDP growth, it's still doing very well.
And yet, so actually, let's unpack this a little bit. I agree with that, Matt. It does look like things are overall pretty fine. However, if you look at some of the things that I guess are more typically a leading indicator, and I'm just going to rail them off. This is a polemic statement I'm making for you guys to respond to, but the argument would be job ads down. We saw a severe update from People Infrastructure at the AGM where they're like down, I think it was like, 25, 30%. Now they're obviously highly leveraged cyclical business model, but these would be potentially the early signs that the heat's coming out of the employment market, for example. On top of that, we've got retail sales. I think we've seen, by and large, retail sales on a same-store basis anyway have been down. You've got some companies that are like in constant rollout mode, so they sort of, even with same-store sales down, they're sort of managing to look okay. But same-store sales are generally down. We're probably seeing a few exceptions to the rule here or there, but even people buying gadgets at JB Hi-Fi is down slightly, and let alone perhaps the more less important things like candle making, scented candles, overpriced scented candles, indeed, taking a big hit there. So
why are you laughing at candles?
What company are you talking about, Claude?
It's like stock's pretty cheap now, actually. I was alluding to Dusk for anyone playing along. Obviously, the quality of a business and the price, interplay, whether or not there's an opportunity. Obviously, the quality of it as a retailer is not particularly great, but, well, my opinion, but the price is also quite low as well. So there could be opportunities there. But the point is, some of these companies have definitely taken a hit. So that is what I put to you as evidence of weakening in the economy.
Yeah. No, I'd agree. I'd say Australia is also a bit different from the US, right? Like, I don't think Australia, like Q3 in the US, I think was like almost 5% GDP growth. It was like real GDP growth. So I don't think Australia is anywhere as strong. So I do think we're having, like, because the US, all the mortgages have fixed their rates, right? So like, we're not even having the mortgage effect. And then obviously anyone who has savings is getting more money on their savings.
It's so easy to forget that, Matt. But it does have a huge effect, especially on something like retail.
Yeah, exactly.
You'd expect it to, right?
100%. I think that's what's happening in Australian retail is what you'd call the mortgage belt. They call it, is getting hit or is choosing to pull back, right, on discretionary spend, and had been spending pretty hot for a couple of years.
So hot, man. I should see my friends, like, usually I'm the one that's spending the money, and then like suddenly after the lockdowns ended, like just every single person I know is going nuts on spending on like expensive stuff.
As I understand it, we've still got a bit of spare capacity in terms of saving buffers on aggregate. So the collective have been burning through it. In other words, we're spending more than the income that we're generating, which is fine when you've got a big pile of savings to draw upon. And we have been, but it's just that's running down. And as I understand it, I think extrapolating the trends that are there, that actually carries, like, you can maintain the current level of spending for at least another 3, 4, 6 months, something of that sort of caliber, which is interesting, right? Because you look at these things and you'd think, well, who isn't aware of that? Pay comes in, credit card bill comes in, there's a mismatch, I draw on the savings. I mean, we all do it, right? I'm not having a go at people here. It's natural. But after a while, you might kind of think, our savings have halved and all we have is this jet ski to show for it. Like, at what point do you go, maybe, and I don't know. Is that too naive and optimistic that people will be
on people?
Yeah.
I think it creeps on people because the thing is that I've had is like, I was like, yeah, I don't really care, whatever, inflation, I'm fine. And then it's like a couple of years into inflation, I'm like, damn, I feel like everything's like doubled in price. Like,
it has doubled more or less, right? Like you don't have to carry forward 5% inflation for that long before prices, and particularly in some of the series within the broader CPI, like, it's up quite a lot. You notice that. There was a really good interview I saw with the former head of the Reserve Bank of India, basically making this kind of case that it's not until what you want to do with inflation. He was asked about specifically the inflation target. He goes, it's completely made up. But the idea, it doesn't really matter where it is, as long as it's at a level where people don't notice it. That's the level that you want. And I just thought, Yep, that's pretty much it, right? It's like there's no like mathematical formula that will say above this point is a problem, below it isn't. And it's just sort of like, no, we just don't want it to notice it. And people will notice it at sort of the upper single digit kind of level, and we won't notice it lower single digit.
I wonder if and when it will, like, I bet you it's hit goods, like, as in the buying slowdown, the people tightening their belt. I bet you it's hitting goods sales, like retail sales of things, first and harder than other aspects of retail. My thinking behind that is twofold. First of all, when we were actually locked down, you could still buy things, right? So you still might have a car or a phone or something that you bought during lockdowns. And then the other thing is, obviously people missed going out and doing things, so they like wanted to do that extra demand. But, the price of going out for lunch or whatever, or getting drinks, I don't know how I would have afforded it. Like at university, the current prices in the pubs to get a beer, it cost nothing when I was 18 or whatever. And I wouldn't have been able to afford it now to live the lifestyle I lived back then. I think it was like $10 jugs or something. And now it's like $10 will pretty much get you a schooner or whatever.
What was
maybe
it
a pint.
$5?
I was waiting for a comment. It was 3 shillings a jug back when I was a lad. I'd write in on my penny farthing and order a cold frosty brew with some shekels.
Very good. Yeah, I think that's fair. So okay, so one just reported today was Collins Food. So they're the owner of Taco Bell and KFC. It looks like they're still doing pretty well. So like KFC same store sales in Australia were up, I think it was 6%, total revenue up 9%, underlying EBITDA up 11%. KFC Europe same store sales up 8%. Taco Bell up 8%. Here you go.
Doesn't surprise me at all.
I feel like it really supports what I was saying, and I didn't even connect the two in my head.
There you go.
It doesn't surprise me in the sense that this is the cheapest
exactly
takeaway food you can get, right?
That's what it supports, isn't it?
I mean, in fact, I wouldn't be surprised you see people sort of maybe even trade down
to it. Yeah, exactly.
Yeah. So this is
Providor went bankrupt, right? There was a delivery of like restaurant meals.
Right.
Fancy restaurant home delivery. Yeah.
Yeah. I just think you can be doing it really tough, but when, you're hungry and you're out and you see a, $5 meal deal, you'll get it, right? You might hesitate on the new car or something.
That's the thing as well, though, right? When you're talking KFC or Domino's or whatever, like they're actually buying it there from the restaurant. It's not that much more expensive than if you made it, bought from the supermarket and made it yourself, kind of thing.
Yeah. It's kind of it's a value food buy, whatever.
Yeah,
yeah. Anything else?
Just
don't factor in the cost of Ozempic you're going to need later.
I was going to say there's the externalities of living on that diet, but yes.
Yeah, that's fair, man. What are some other ones on the ASX? Does anything else jump to mind of like services, businesses, and that trading down?
Well, Domino's obviously.
Yeah, Domino's,
but perhaps not cruising along as well as Collins Foods.
What about Lovisa? Right. So this is interesting because these are super cheap items. It's hard to think of a better current ASX example of the so-called lipstick effect, right? Like it's just
exactly. But didn't we figure years ago that the lipstick effect isn't really actually that real? Like I swear that's where I ended up landing on that. You get introduced with this idea, it has this sort of like folksy appeal to it. But then once I started to explore the literature or the studies to see if this was like a real thing.
Oh, I have certainly not done that. I tend to take an idea.
I'm not saying that I'm right, by the way.
I run with it because it feels right.
Yeah, no. I thought it back in Motley Fool days. I remember researching it. I could have swore that I shared my findings with you guys then, or if that was some sort of group activity. But maybe we've just all. Yeah, maybe I thought you guys were listening, but you weren't.
Just like wait a sec. Does this reinforce my prejudices? No, not interested.
No, we're probably like, what are you talking about, Claude? Like, this is not a time for worrying about lipstick. Just buy another tech stock.
Lovisa same store sales are down 6% globally.
Yes,
year to date.
That is true.
Maybe that
is true.
Saying that they're not benefiting from, if there is a lipstick effect, they're not getting that benefit.
I reckon the effect, if it exists, is not that goes up. I think that it's just that it doesn't get hit as hard as some other things.
Yeah. Which is less exciting from an
Yeah,
investment point of view.
exactly.
My daughter's not of the right age yet, but she's coming to. I just can't imagine her going, the economy's a little bit shaky and, inflation's a bit higher than I think, so I'm not going to spend $6 on this bracelet that I really want for the party tonight. Like, it just drawing a line between those two things is very difficult. And I'd be interested if someone is, and I'm sure we've got a very astute and worldly audience. I'm sure some people have some good data on this. If there's something you can point to here to suggest that this isn't a phenomenon, I'd be really interested in that, because I'd imagine it's a pretty core part or important.
Talking about lipstick.
Yeah, of the lipstick effect.
Uh-huh.
Yeah, just.
No, well, the lipstick effect is like it's a spoiling yourself thing. That's the idea, right? That there's certain that during a recession, like chocolate biscuits do well or something like that.
You don't have a holiday, so you get like
a
lipstick instead.
Yeah,
and the opposite is true as well. Like when things are booming, it's not like I'm going to buy 8 times more lipstick than I otherwise would. It's not. It is the kind of thing that I will buy because I want to buy it because I like these little luxuries, and it's the thing that I will continue to buy even when things are tough because it is a little luxury, and I'm feeling pretty crappy about the current situation and how tight things are. But
why are we focusing on lipstick? Like, none of us have any idea about it.
It's a horribly gendered example, but it's a good one, right?
Yeah, I mean, it's all marginal, I guess. That's the other thing with same store sales, because you think like, oh, well, people will still like their candles, they're like buying there, but it's just, does 8% less. That's what, like, it's just, do you buy 8% less? You might even still go shopping there, but is your basket size just that little bit smaller? It's not that much if you're spending like $100 to spend, $8 less in total than you were before.
Yeah.
Like, it's all these little marginal decisions
Totally
that add up to make it a tough headwind for retailers. But yeah, I mean, I guess the other broader question for retail is like because at some point you'd think these things start leveling out, but do you wait for a recession, or are you thinking like we've already got pretty negative same store sales for most retailers? At what point do you jump in? I don't know if you guys have any thoughts on that.
Yeah, I mean, timing's diabolically hard. I don't know, but I do think that there is something to be said about, I think you've at least for me popularized the term, Matt, nowcasting, which is that idea of just like, I don't have to predict the future. All I know is now that things are in a bit of a funk. All I can tell you right now is that, PEs are potentially compressed a little bit. So I've got lower PEs on cyclically low earnings. It's probably a good bet if I'm betting at for any reasonable length of time across the cycle, even though it almost invariably the share price will drop 30% after I buy it. It may well still be an incredibly positive move. I'm not there yet personally on Lovisa. I think the PE is still up near 28, something like that. But yeah. Anyway.
Yeah, I think that the opportunity will come. So there's going to be some retailers that are actually just get killed in a slightly more hostile environment. But putting aside those ones, for the ones that are sort of, there's something there, it's going to be an enduring business. I think that the time to buy, obviously we won't ever be able to predict it perfectly, but it will be different for each one depending on the sort of story and the narratives around that particular company. So for example, I think we already had the sweetest setup for step one, this company, which actually does have probably like an enduring offer and was hit really hard and then did get.
Is that the lipstick effect for you, Claude? Do you spoil yourself with another pair of $40 undies when you the rest of the economy's not going so well?
No, that's why they got me though. Because now I'm like, this is just how I get my undies now. Because actually, yeah, I guess the treat part of it is I don't want to go to Kmart. I just don't want to physically put my body there. So yeah, just being able to sit at home and then like choose between a variety of like colorful designs. I'm like, yeah, this is fine. Yeah, so that's still my favorite like one that got away, which I totally would have bought. It's just that I don't want the responsibility of writing a recommendation for like, retailers basically.
I'm a fan of Kmart, man. We got a good Kmart. I think it depends on your store. There's one I went to and I was in Auckland, which was like, it was like post-apocalypse every time you went there. Like everything was just everywhere and destroyed. Yeah, go to the nearby one. I appreciate the value. Spend $20, you get like 6 toys. I don't know.
Oh yeah, I shop there. They've got good Lego prices too.
Yeah,
that stuff's killing me.
I tell you, man, it's false value.
Kmart?
Yeah,
oh yeah, the toys don't last too well. I'll tell you, man.
All you do is you end up with a garage full of crap. Is all you do, right? I would far prefer to spend like 5 times as much and have a really high quality toy that last. I mean,
Lego. What are you
Mum
talking
and Dad
about?
have still got my toy trucks at home,
Yeah,
right?
Lego's
From the
high quality.
70s. You know, Lego's high
with
quality.
some nice lead paint that lasts forever, eh? That's
It all.
It's like, this toy that Andrew used to lick explains a lot.
I went to this museum where there used to be like radon, like radium was put in some toys, eh? There was like atomic.
Yeah. They were like nuclear power game.
Go in the dark with your friend. Whoa. All right.
Here's an interesting idea for you in retail, which I don't know how I even got onto, but what about baby bunting? Because, you know, you would have thought there's like sort of at least some degree of, it doesn't seem like a good business to me, but the argument has been made that, you know, people will spend on infants, so it's a good business for that reason. And of course, it's, you know, not as expensive as Lovisa, or not as much growth priced in.
Yeah, I think it's a good case for it. I don't know. There's a lot of retailers in Australia where I get really nervous about Amazon if I try and do like a DCF over 10 plus years. I mentioned that one before. There was another thing actually that just caught my eye on this topic. So sorry, I don't know I'll let you talk to Baby Bunting in a sec, Andrew, if you got thoughts. But the other one was China's Temu, which has taken off in Australia. So this was an AFR article a couple of weeks ago. Chinese marketplace Temu was shot to number 3 spot in Australian e-commerce rankings, unseating better known homegrown competition Kogan, Catch, and MyDeal just 6 months after making its debut. Temu is a bargain lover's paradise known for its tagline "Shop like a billionaire." Steep discounts for items from replacement toothbrush kids to kitchenware to sneakers. It's expanded 47 countries, 120 million monthly users globally. In Australia, 7.6 million visits, bigger than Wesfarmers and Woolworths' own marketplaces.
Wow, I missed that.
Yeah, this is a category. The category is dominated by leader Amazon at 50 million monthly average visits over the same period. But yeah, basically it's just come from a standing start. It's like very cheap. Together, everyone, I don't know what the tagline is, but it's like group buying, like kind of, it started as like group discount buying, like they'd put like huge orders for like a few products. But yeah, I don't know. Have you guys come across that?
No.
I think I've seen an ad for it or something, like, you know, when you search for something.
It'll be like obscenely cheap stuff for the few things that it has is normally how.
Yeah, I do largely agree on Andrew that buying stuff from own vendors online, you end up getting some really random outcomes. Like I remember one time my wife bought collar tag for the dog off some, you know, overseas random, and she just got sent like these 2 little random funky plastic earrings instead. and that's it. Like,
yeah.
End of transaction. Like,
so I'm just opening it up now. Okay, here's some of the things. These are like, a lot of these are pretty crappy type stuff, I'm thinking. A fast charging thing for a car, $4. Something that looks like it's an iPhone, or like a Apple Watch, is like $11. Yeah, it's just obscenely cheap versions of stuff, I guess. But some of them probably are fine, you know.
Is there like an inventory clearance mechanism, like Chinese warehouses?
Yeah,
or
like
something,
it kind of is. I think that's part of what they do. I think that was part of like their base originally, was doing stuff like that. It was like, yeah, you end up buying some junk basically. Probably is what the outcome is. But
came to our earlier discussion from a week or two ago, right? Though if you're in retail, be either cheap and nasty or super premium, one or the other, right? And then they've done that, and in surprise, they've sort of, well, seemingly from what you're saying, unseated at least impacted others that try to play in that space. It is potentially a race to the bottom unless you can be the last one standing with a positive margin.
Yeah. Anyway, yeah, the Amazon I'm probably a big Amazon user. I don't know, like I prefer that. I hate wandering around a shopping mall. It is my personal nightmare. And so yeah, I instant order on Amazon for like, there's a certain price level where I just order it, and you know, now stuff typically comes the next day for me for a lot of things, but it won't be long in our major cities where I think it'll be in the hour. Like in the US, it's in an hour to have it delivered, and that just is a radically different experience. If you push a button, you shop in 30 seconds, something appears within an hour. Like you're not going to the shops for a lot of stuff. You know, a lot of baby stuff is you need little thing, you need another bottle, and you end up buying some other big thing when you're there. You know, like, and so that kind of kills a bit of the baby bunting, maybe.
Well,
and also sometimes with babies you need it now, and so that might make you go into a shop. But if Amazon's the next day, then obviously it's
or the next hour. Yeah.
It exemplifies your comment in regard to other things though, Matt, whereas you want it to be the destination. It's not like you're Googling it and then, oh, there's Amazon, I'll click on that. You bypass, you're just opening the app up, right?
Yeah, it's search.
That is special when that happens, when it's just, I'm not, and I've caught myself a few times because I do the same and then think, actually, no, I will have a look around and I do find a better deal. Right? It's just the assumption that it's going to be cheaper. This is the genius of one of the things that Bunnings did so well. It's like lowest prices guaranteed. If you find anything else, we'll beat it by 10%. It doesn't even have to be true. It's just like, I guess they're the cheapest and the biggest. I'm going to go there. Right? I just am, right? I'm not even going to bother looking anywhere else. Really smart.
And you get a sausage.
And you get a sausage.
I always end up buying the wrong thing from Bunnings. I have to go back and exchange it. Yeah. Anyway,
I bought some Bunnings, bought some owl stuff to try and keep possums out of my yard. All right.
Did it work?
No, I don't think so. I think the possums are just dancing in front of the owl. They don't care. Anything else caught your eye over the last few weeks, Claude or Andrew?
It's really starting to wind down. I mean, we've got the AGMs sort of happening, so there's a bit of info coming out of that.
Yeah, so we had the Altium AGM, which Raymond did a little write-up for us on the website because he actually went to that, which I good to have, because they didn't actually stream it, so good to have that report there. And I guess, probably the key takeaways from that is that what you can't read from the presentation is that, that they seemed to be confident. They reaffirmed their aspirational targets. They said they're on track for their guidance. And look, to be fair, there hasn't been any big move in the share price since the Altium AGM. So probably the conclusion is nothing really came out of it, good or bad necessarily. But, I guess, Raymond's words were that the CEO exhibited calmness and pragmatism in the way he spoke about Altium's future outlook. So I think that's sort of, I guess, somewhat reassuring vibes there. And obviously that's a company I own. So I just want to continue to see that it becomes a sort of one of the de facto tools that designers are using, and one of the the main softwares that people bother to train on and learn and use. And if you kind of become a standard like that, obviously that's when you start being more and more sticky, because the more people have used your software for 10 years, the more annoying it is on a human level to change.
Very true.
Yeah, that makes sense. And did you want to talk about Vysarn or?
Yep. Yeah, we can just scoot through a bit more small cap news. So Vysarn, definitely one picked up by Benjamin Sayers, who covered it when it started an upgrade cycle around 6 months ago. That would have been another one, probably cyclical industry to a degree, being in mining services, dewatering and a few other things. And it's had a big run since then. So it makes me de facto cautious when I see the stocks doubled. But, after the update for the AGM, the first 4 months was reporting essentially he believes that it's on a good trajectory. Essentially, I personally don't really have a view on. I find these little mining services companies very difficult. I've seen them be very cyclical, so they're not really the droid I'm looking for, in that they're not probably necessarily a 10-year hold. But I think it's, again, one of those things, if you get them at the right moment, then it's on a growth trajectory. That's the beauty of small caps, right? If the profit's just growing that much, and the P ratio isn't too bad at the start, then you've got a very good, reasonable chance that the share price goes up with the profits, even if you don't get a re-rate on the P ratio. And I think that's the argument for a lot of these contractor kind of businesses that have been successful. Yes, we see Vysarn, but we also see one that I owned previously and once again sold out of too soon, Duratec, which I think is another story. Yeah, they've got a re-rate as well, but a couple of years ago, they were on, because their earnings had been hit by COVID, they were on a low PE ratio, and then they just proceeded to, through organic growth and also acquisitions, grow their earnings strongly. You get a re-rate on that PE ratio, and what could be a very sort of ordinary business has a spectacular stock return. So is this a kind of area where I think it makes sense to fish? Yes, absolutely. At the same time, it can be hard work and it can be a little bit dangerous when things turn against you. But for now, I think it's worth highlighting the ones that have got good earnings momentum, and I think Vysarn falls into that category.
Yeah, I haven't looked at it closely, though. I really should, based on what you said. That sounds very interesting.
Well, I definitely think it could grow a lot. It's just that, how these businesses also, you have to look at their balance sheet. Once they start introducing debt, they become much riskier, of course. But when they're strongly in cash, you'd argue it's not as risky.
Yeah. What about anything small cap been discussed much on Strawman lately, Andrew?
I'll just throw a cheeky go Catapult in there. Thank
How's
God.
that going? We chatted about that last week.
$1.30 as I look at the screen now. Yeah, it's been an incredible trading stock, in the sense that if all you ever did was just buy when it was below $1 and sell when it was above $2, well, you could have done pretty well over the years.
Yeah.
Hopefully that doesn't persist, because I would much prefer just to hold the damn thing and it just to consistently go up.
It's like an ancient curse for all your stocks to be good trading stocks.
yeah, exactly. Yeah. I don't know.
You've done very well out of buying and selling that one, I think.
I wouldn't say use the word very. That's over egging the pudding. But yes, yeah. I mean, anyway, I just want to chuck it in because I get plenty of flack when it's down. So you got to even it out.
Yes. All right. Anything else catching your eye?
No. Other than I think it's an interesting time of year where once we get through these AGMs, the news flow is going to really dry up, and I think that causes a bit of anxiety along a lot of stock pickers. For me, for one, I really welcome that. It's nice. So I
still think if I was free to be a bit more flighty and whimsical, I still think there are probably some good takeover offer kind of companies on the ASX at the small end. We saw another one come in today, Namoi Cotton. They're still coming at a regular.
Door Beauty, right? Door Beauty's just had an offer.
Yeah, exactly. Or a discussion on an offer. I can't remember now. Yeah. But I think
they rejected an offer at a higher price.
They rejected it.
Yeah.
Yeah, right. I think there are a few like that. And look, Door Beauty could be an interesting one. Itself in retail obviously doesn't actually have the earnings to fall back on at the moment, so a bit riskier. But, we're seeing takeover offers for companies that are still loss-making because those loss-making companies have gotten hit so hard. So, yeah, I'm not really fishing in that space myself, but I think it's interesting. The other one that I wanted to talk about or touch on, I guess, in the news was that Ensurance got taken over by PSC Insurance. So that's another one. We're also seeing, and which I now own, PSI, which is PSC Insurance. So I think we're seeing a lot of mergers, and I think there are merger arbitrage kind of opportunities, takeover arbitrage kind of opportunities. So that's probably one thing that I'd like to, since I've just had a bit of that in my portfolio, I'd like to have a few more of those angles because I've never seen the picking so good for actual takeovers going through. I'd probably stick more to the companies that actually have earnings though. And then beyond that, there's a lot of we're going to enter a better zone for picking small caps, I think, when we already have entered it. The problem is that level of slightly depressed valuations could go on for an indefinite period. Like there's no promise when it... Exactly.
You enter a zone of...
It's like, well, when you're at the end of the zone of excellent buying, then you're having a great time. But if you're at the beginning of it, perhaps, which might be where we are, I'm not really quite sure of, obviously.
I think that's really interesting in the sense that when there are bargains around, it never feels that way. It's never obvious at the time. And it's kind of like, well, what do you want if you're a stock? But you want things that are uncertain and scary and cheap. Like, and like any good sort of narrative, there's got to be a degree of truth to it, right? And there, like, in other words, some of this fear is very well founded, particularly in areas. But as we've often remarked, or at least I feel as though we've said it a bit, is that there's the baby in the bathwater phenomena, and there's a lot of high quality stuff that's been dragged down. That's why there's more enhanced takeover activity, because others are sort of seeing that. And I feel as though, not that I've heard a lot of people say this, but it's that the easy retort here is, yeah, that's true. I'm just going to wait for things to get better and then I'm going to pull the trigger, which is kind of like, I get the sentiment, but once it's sort of obvious, the opportunity is, a good deal of it has sort of passed.
You won't know that was your opportunity until it's over, kind of thing.
Yeah.
That's the nature of this.
And where I struggle with it, I mean, it's your point, Claude, is just sort of like, I think there's definitely a lot of companies you can make a pretty objective, rational case for value. But that doesn't mean it can't drop 30% and sit there for 2 years before you might look back in 10 years time and go, wow, that was an incredible investment that I made, and look at my compound annual growth rate. It's just going to be a shitty couple of years though. I mean, that could easily and often tends to sort of be the case. I don't know what my point is other than to sort of say to investors that are out there is like, and I may be saying this more for my own benefit than anything else, which is maybe you need to be a bit more aggressive at this point. I know it's sort of scary, but that's kind of what,
You're on point. That's the point of getting together as small cap investors, to try and discuss some of the emotions of how the market and everything is affecting you so that we can make good decisions. And we don't necessarily know the right decisions, but at least we can dissect our own thinking and the psychology of it. And you really got me thinking with that. It's like, I have one solution to that fear of how you're like, oh, well, I'm just going to wait, I'll wait, which I feel, by the way. And I'm not saying you should always obey it, but that's why I'm saying, well, what are the ones that I can push past that fear on? And the one thing I feel like is the easier one is just buy something that's not really a tiny micro cap or a small cap anymore. It might be a mid cap. It's proven its quality. And I think when you buy actually a genuinely high quality mid-cap business that does have plenty of room to grow still, you can still do quite well. And also, they're a little bit better sleep at night stocks because basically if they're growing, then in a way, all you have to do is just keep holding. And if you have correctly called that due to the high quality nature of the business, it's very highly likely that the profits will grow over time, then it's the ultimate kind of time is your friend thing. And I think that's where we're most likely to see, actually just hold and you're going to be okay. And there will be times when when the market gets pumpy again, what really flies is these small mid-growth stocks that are at the edge of ASX inclusion and funds are positioning, and it becomes more about flows. So, I mean, that's a huge part of my portfolio, and that's the thing that I feel most comfortable in adding to, because even if I'm screwing up the timing of it right now, the time is my friend on this. The business just needs to keep growing, and maybe you can time arbitrage it. You should be choosing businesses that are going to last way more than 10 years. They're in now. They're locked in to a system somehow. And that I can get across the line on it. And then the other thing that I think which is harder to get across the line on, is all of these businesses, most of these businesses that are getting takeover offers, they've gone down really low. But the reason they've gone down really low is there is something really scary about it. And that's the one that I feel less comfortable. It's scarier to try and get to try and recommend such a company because it can just go wrong. And actually it turns out it was terrible.
Can I add to that? Because I think you're 100% right, except that it feels as though that the ones that are more obviously high quality aren't cheap, and the ones that are cheap have all of these problems with them. So it's kind of like you either take the quality at a fair price, and there's a very famous octogenarian who sort of advocates for that sort of approach, or you take the less than wonderful business but at a dirt cheap price. I feel like that's the sort of dilemma at this point.
Yeah, well, I actually think we are seeing a bit of. I think there's a lot on offer, though. That's why I think Greg Hoffman's making that statement, is that you are seeing, for the first time in a while, there's a few options. There's also some small cap stuff that you would probably call classic growth at a reasonable price stuff. So teens PE ratios and growing reasonably well. And I think that's I guess some of those roll-ups some of them are in a decent position. There's a bit of a dividend yield there's stuff like that. But it's those takeover option ones. They're the ones you could get 40% or 60% in a day on, or something like that. Another one that came to mind, and probably a good example, what are the other ones like this? Let's take a look at and take a talk about Diverger, which I don't know if we've ever mentioned on the show. It's a small financial advice business. It was trading at a pretty low PE ratio, so around 10 or something like that. Had a pretty high dividend yield, 5% plus. So on the value, you could kind of buy it and you'd be like, yeah, I can sort of see the value here. It's quite possible I'm buying it cheap enough that, I'll just get my money back in dividends in the long term or something like that. And then it's gotten a takeover offer, which was not very generous at all, that arguably undervalued it. Then shareholders came out and said, hey, come on, and it turned out it leaked into the AFR that there was another higher offer. It was a bit of a really low price takeover. It didn't really make sense why the board was recommending it. Anyway, then they've gone and got a slightly higher price there for Diverger, which still you could say is not that generous. But the point is, you're seeing this notching up of the price that can happen as well. And also that was buying a profitable dividend paying company. I think that I want to, if anyone's listening and you got the other Diverger candidates out there, I think I could definitely make space in my portfolio for something like that as well. And because I think, maybe the only way you're going to get a real free kick is if you get that takeover, but probably the downside's not too bad, as opposed to one of the loss-making tech companies where you could get a really nice kick from a takeover as well. But also there's a higher risk of that takeover falling through, or just not coming along or something like that.
Yeah.
At least if they're profitable, you can hold on while you wait for the mythical takeover offer you might get.
Yeah. A bit of news from a week ago. I don't know if we touched on, I don't think we did last time, was Playside increased their guidance again, which was nice. So they're basically on track for a 50% lift in revenue for FY24 following, I forget off the top of my head, but pretty amazing growth in the year before it. That's a stock you could have made 50% on in the last little month or so. There's things are moving around, and it's the kind of stock that could be down back at those levels next week again. But Anyway, I thought that was an interesting point. They seem to be kicking some goals. I've got a small holding in them. I'm very cognizant of the fact that I really like this sort of work for hire kind of baseline revenue, but what we need as shareholders to get really excited is a hit on Steam. Like that really changes things, like
I definitely think I've never been able to really get comfortable with the valuation, but I definitely think this is a one stock that could once again fetch a really high valuation. It's got like a lot of elements there, capture the imagination in the market.
And it's only, well, it depends, right? So if this top line growth is the biggest ifs in the world, right? So it's Captain Obvious here, but still, if the revenue keeps growing at the kind of way it has, and if it sort of sustains the recent cash flow positivity and scales well, it may not be nearly as expensive as it looks. It's just hard to handicap. It's like betting on a Hollywood studio coming out with the next Iron Man. Like, is it possible? Sure. Like how, when and how much, like it's really hard to handicap that kind of stuff.
Yeah. But now so many people's watching, I feel like the share price will move, as there's a game success. So it'd be hard to get ahead of unless you're really across the actual game itself. Yeah. Unless you sort of saw that they developed one that was going to be a hit.
Yeah. I don't know what this is probably not the topic to sort of wade into at this late stage of the pod, but it is. I've been thinking more and more about AI and some of the breakthroughs that are happening here and what industries are going to be disrupted by that. And the short answer is everything, it seems to me. But it feels like I've seen some really cool stuff. We were talking off air on some like the capacity to produce feature length movies from a few prompts, and that's probably not that far away, right? And I suspect this same kind of things can be said about games development as well, right? And what does that do to a company like Playside? I can actually go both ways on that. On one hand, I can say, it's terrible, because now anyone can kind of do it. On the other hand, I can say, well, you're probably going to still need someone steering the ship, and you're still going to need some technical chops to sort of bring it together, at least at this stage. Maybe in 10 years, that's completely changed. But yeah, I don't know. Very broad comment. What do you guys have any thoughts on that?
So it's basically, I guess this goes for a lot of domains, right? That you could have AI, like an AI could write a book right now. Probably wouldn't be the best book in the world, but it could write a book kind of thing.
Mm.
Yeah, I guess it just depends what we value. I think there'll still be, and it'll still be people based, because I think it'll be like, there'll be like the movies are very like power law based, right? So you probably have this like flood of movies, and I think there would still be, I don't know. I guess at that point you're getting towards like super intelligence, right? Or if it's like better than humans at everything, but let's assume it's not, then I think it would still be like humans. Like it's kind of like coding right now, right? Like you could say that coders are obsolete. Actually, I think it's the opposite, because now they're just super powered, basically. Like a single coder can do an immense amount of work, but you still do kind of want a human there, at least for the foreseeable next few years.
Yeah, you're directing traffic. You're more a coordinator than the more grunt level work.
Yeah, correct. You know the right questions to ask, right? Like you or I would struggle to get ChatGPT to build like a Facebook clone, right? Because we just don't even know like all the different types of databases, blah, 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 all the work that would be required.
Yeah.
It could have some bugs, we don't even understand them, right? Like it's understanding enough to know the right questions to ask, at least in the current model of AI as tools. I don't know if we're going to get like proper agents. At the moment, they're not that smart, right? In a way, like ChatGPT just regurgitates statistically, predicts the next word kind of thing. So yeah, I don't think we're there yet, and hopefully not for a while.
Yes. Yeah.
Any other thoughts? Should we wrap it up there?
No, I think that's it. Always happy for suggestions from the crowd.
Did you guys want to touch on Smartpay, which reported its results last night? H1 results.
Oh yeah, give us a rundown.
Well, it's not one that I've owned and I don't know it well, but I can tell you the numbers, which was actually earnings per share, it looks like down a little bit. Net profit after tax down, net profit before tax up. So they've started paying tax, that's hit them. But also if you look at the half on half, their net profit before tax was down slightly on H2 in, so the immediately prior half. And also that was because of a cyber incident, about $1 million hit there. And they normalized it, and if you normalize it, then it was kind of flat. It was 4.8 million net profit before tax versus 4.7 million in the immediately preceding half. So I'm not trying to say that means the business is bad or anything, because I just don't know well enough. Perhaps there is, sort of some reason for that. But, on the face of it, they did 1.1 cents per share earnings in the first half. Even if you double that and add a little bit, you could say that they're going to make 2.5 cents. I don't know if that's accurate or not. It probably isn't. But I'm just pulling that out of thin air just to demonstrate the fact that, the share price is $1.34. Okay, that was... Also, is that Do they report in New Zealand dollars? I can't remember.
I'm just looking at forecast EPS for 2024 is 4 cents. So on a forward basis, assuming that's great. Yeah, it's 34 times PE, I guess, at this age.
I wonder how it gets to 4 cents when it was one.
This is consensus analyst guidance, so take it.
There might be reasons for that as well. I'm just saying, on the face of it, looks like decent business, but also I don't know. I don't get to the multiple. The multiple's not easy for me. Like, I don't know how they get to that 4 cents, for example. If we look at the half that was, and even more than double it, even if we say 3 cents, then it's still.
This should be a bit stronger half, right? With Christmas for like a trading period, I think we'd have a bit more transaction value normally.
Yeah, so they should have a stronger second half. That's fine. But even if we say the second half's going to be earnings per share double the first half, then that still only gets you to about 3.3 cents. That's New Zealand cents, by the way. So what's that in AUD? That's 3 cents pretty much, or a tad over that. So yeah, any way I look at it, it just looks like it's definitely got a lot to do in that second half, which it may well do.
Yeah,
definitely not calling it out, just don't know it well enough. But the reason I don't know well enough is because every time I've looked at it, I've been like, oh, well, this seems pretty expensive, and it's just gone up. So, take what I say with a grain of salt.
The weird one with this is it's got a very well-known thesis of that they're going to roll out their terminals or their revenue share product into New Zealand, right? So they've got all these terminals there, and the idea is they're going to launch their Australian business model into New Zealand.
That's right.
And if you join any results call or anything, that's kind of all the questions are about that, and everyone's kind of baking it in. I guess I don't know, just kind of question. I was kind of interested in your guys' thoughts of times where that's worked out, because it kind of feels like everyone who owns the stock, everyone who's thinking about it, all knows the same idea. Kind of goes with what you're saying, Claude, about like obvious ideas maybe, but it just seems like it's a bit like you don't really have a variant perception. Perhaps maybe it's a bit too obvious, maybe it's a bit too baked in. But yeah, just kind of curious your guys' thoughts on that.
Yeah, I think that when we have these. I think last week I was talking about, sometimes just the first order thinking works. It's about being early to that though, because this first order thinking, if the idea is powerful, it will spread. But you make the gains in buying Microsoft shares the day the obvious thing comes out. And then that obvious thing takes a long time to spread out through and just become accepted reality and priced in. And yeah, sure, it gets priced in way before it actually happens. But the first order play is when it's something that's powerful enough idea that it will spread. And even if it moves up a bit, what I've found is you think, something comes out, Microsoft's up 10% or whatever it is. Like, dude, that has not been fully priced in yet. The fact that when a small percentage of people found out about this thing, they bought it 10% shows how they pushed it up 3 or 10% or whatever it was. That shows how powerful the idea is. You wait until that idea then spreads to everywhere. It's going higher. That's the idea of the buy the first order effect thing that they say works. But then with S&P, it sounds like maybe now we're at the point where like actually this idea has fully spread and it has been priced in. So now it needs to deliver, and ideally deliver even better than what people think. And the reason that I've not gotten enthusiastic about it is I just look at the industry and I'm like, how is it that Tyro is such a dumpster fire and you're so good? Like, you guys are doing basically the same thing. And then there's other competitors as well that aren't listed on the ASX, and it just seems super competitive. That's the only
you hit
thing
it, man.
I have a problem with it.
That's my issue. And it's not that I have a bearish view on it. I can't get a hold of that. It strikes me as a business that is extraordinarily well run. Just like, beautiful operational excellence. They've got their pitch down, they've got a good product, and they're just executing. And I guess that's a moat. I guess it is. But the durability of that is hard to do it. And again, they're big players that you're competing against. And I don't know what retailer wouldn't happily switch if that option was given. It seems like it does not necessarily.
I blame my local pub for keeping me. I missed Smartpay because of my local pub, because they just keep on changing it. And they had Smartpay and they changed it to someone else.
Yeah.
And at the time I was like, oh, that's not good. And then I asked them why, and they're like, some other thing was lower fee or whatever.
Yeah.
But then I've noticed they keep changing it. And I think that what the pub's doing is that there are introductory offers. Like, they negotiate some discount to change. Yep. And so they just keep on changing to get the best possible terms. Because they've been through like 3 at least.
Well, that's interesting. That's the point, right? Like, that's interesting. Like that to me, like, is the one data point says there isn't.
Yeah. But it also might, so that's what it was saying to me as well. And that's why it's affected me. But now I'm just digging into why I think something. And it's like, well, maybe I've just based this view on this one data point that's not representative. And there's just the guy that runs my local is just particularly dedicated to minimizing transaction fees.
Yeah, he's probably an outlier. I mean, I would imagine a lot of small business owners have got far bigger fish to fry than trying to squeeze a small saving out of their POS terminals. I really get that. Inertia is a real thing, right? People are lazy as a general rule. I sure as hell am, and so I can totally see that. But it's just, I don't know. I know a lot of people really like it, and you can easily see why, given how they have delivered. I did just noticing the most recent presentation. They got a Thomas Edison quote saying, "Vision without execution is hallucination." So they're obviously proud of their execution, and they should be.
And also, I think that their charts were good because they gave the half by half breakdown. What I'm trying to say is, from looking at their presentations, I actually think they are doing a pretty good job, in terms of how they're communicating with the market there. So good on them. Look, one final little bit of news I wanted to share is just for your watch list and stuff, obviously, because it's a decent company, is that PWR had a market update. It was marked non-sensitive, but the share price did move down sort of after it came out. And what the update was, and for those listeners who don't know, PWR is cooling technology. So they got famous for doing, cooling systems for Formula One. But obviously growth areas include, space and military purposes as well. And what they said is that, as indicated in PWR's forward OEM pipeline over the past 2 years, PWR has been supporting the development of battery cold plates for a high-volume electric vehicle program that is due to commence production in 2026 for a period of 5 years. PWR has been in commercial negotiations for the production phase of the program, and it advises that it has withdrawn from those discussions for commercial reasons and PWR's assessment of risk. So what do you guys, and then it goes on, it says, look, they remain committed to growing their OEM business responsibly, etc., etc. What do you guys think of that? Is the market right to be marking down the stock in response? Matt's about to sneeze, so he's not going to answer.
I don't, man. I don't.
No, I mean, it depends how material the contract is, I guess, right?
Yeah, so it's out of their pipeline, right? So it's something that I guess analysts might have been factoring in, which is why the share price has dropped. The silver lining to this is, to me, the other reading of it, I guess the slightly variant perception I had to the market, which is why I wanted to bring this up, is I was thinking, well, maybe it's kind of good that they're willing to walk away for things. They're going after 20% margins. That, if they can, that means, they got to have pricing power. They've got to be serious. Maybe this is them saying, look, well, this is how we exercise pricing power in our business. We just say no to a deal if it's not going to be good enough. So in a way, you could interpret that as them sticking to doing what they say they're going to do. They believe they're that good and that's what they're going to ask for. Yeah, I don't know. It was more just up for discussion to see what you guys thought, but it's not made me dislike the company just because they've lost this opportunity, put it that way.
Nice. Yep. All right, we'll wrap there. We've hit time and now our internet seems to be dying. Thanks everyone very much for listening. If you have any thoughts, comments, questions, you can hit us up on Twitter at BabyGiantsPod. Until next time, yeah, thanks for listening. See you next week.
Thanks everyone. Have a great day.
Yeah, cheers.